Do you guys remember that Max Kellerman meme where he's like, "Fate of the universe on the line. I have one shot, and I'm picking Iguodala." I think that's still one of the greatest sports memes of all time. And honestly, guys, that is what inspired this video. Because if I had the fate of the universe on the line and I could only pick three ETFs to invest in for the rest of 2026, which ones would I choose? Well, I'd be buying VOO, XLK, and SCHD. Now, I'm telling you right now, you do not need to own a billion different ETFs to be a successful investor. All you're going to do if you go down that rabbit hole is overlap yourself. And you're going to make your portfolio way more confusing. And you're going to convince yourself that you're diversified when you're really not. I definitely, at first, fell into the Pokemon mindset of, I got to catch them all. And then I started buying all these ETFs like they were on a Black Friday sale. And actually, that just reminded me of another all time classic, the Pokemon Go to the Polls. I don't know how my brain works like that, but that is another all time meme right there. Anyway, eventually I found this little magical tool called the ETF comparison tool, and you could just Google this online. And that's when I realized that most of my ETFs, when I first started investing, had over 70% of the exact same holdings. I was basically double dipping into funds that own the exact same companies while I was also paying higher expense ratios for absolutely no reason. And before you know it, you're tracking 10 different investments that really aren't adding that much more value. Investing does not have to be complicated whatsoever. In fact, I think the simpler your portfolio is, the easier it is to stick with it for decades. And as we all know, consistency is what can build serious wealth over time. For me, every investment has to serve a purpose. I want one ETF that's going to give me broad exposure to the biggest companies in America. I want another that's positioned to benefit from some of the fastest growing technology companies in America. And I also want something that provides a strong, high quality dividend income while still giving me long term growth potential. And that's exactly where I land on these three ETFs: VOO, XLK, and SCHD. So get ready, gents, because today I'm going to break down why the most cookie cutter vanilla ETF of all time, VOO, continues to be the foundation of almost everything I invest in. Then I'm going to talk about why I believe XLK is one of the best ways to capitalize on the technology and AI revolution that's continuing to reshape the economy, whether we love it or not. Personally, I'm getting a little tired of every square inch of land turning into a data center, but hey, if you can't beat them, you might as well make money off them. And finally, I'm going to talk about SCHD and why it's earned a permanent spot in my portfolio thanks to its focus on financially strong companies that consistently grow their dividends. And I'm going to talk about why I think it gives me a little extra downside protection too, and how I use my dividend reinvestment strategy with this ETF. So at the end of this video, I want you to understand what each ETF that I'm going to talk about brings to the table, and why I like combining all three of these instead of just picking one. Whether you're opening your very first brokerage account or you're just looking to simplify your portfolio, hopefully this video gives you a framework you can use instead of chasing whatever investment happens to be trending this week. So let's kick things off with VOO, because if I could only ever own one ETF for the rest of my life, this would probably be it. I know this is not the sexiest pick in the world, and every finance YouTuber talks about VOO, so it is a very mainstream take. It's basically the plain oatmeal of investing. That's kind of how I look at VOO. VOO tracks the S&P 500, which means you're investing in roughly 500 of the largest publicly traded companies in the United States. So instead of trying to figure out whether Apple is going to outperform Microsoft, or if Nvidia is too expensive, or Costco stock is too expensive, you just own all of them. You're basically betting on American businesses continuing to innovate, continuing to grow, and continuing to make money over the long run. Historically, that's been a pretty good bet. The thing I love most about VOO is that it doesn't require you to be smarter than everyone else. You just buy consistently, you keep adding to it every paycheck, and you let time in the market do the work for you. That's how the majority of my wealth has been generated, because 85% of my net worth is tied to the stock market, and most of that is invested in VOO. It isn't flashy, but boring has made a lot of people very wealthy. Now, one thing people always ask me is, why invest in VOO instead of something like VTI? And I don't think you could go wrong with either one. VTI gives you exposure to the entire US stock market, including thousands of small and mid cap companies, on top of those large cap companies that VOO has to offer. VOO is more concentrated in the 500 biggest companies, and personally, I like that concentration a little better than VTI because those companies generate an enormous percentage of the profits in the US economy anyway. Another thing I really like about VOO is that it's incredibly cheap to own. The expense ratio is 0.03%, which means you're paying $3 a year for every $10,000 you have invested. That's less than what most people spend on a gas station energy drink. And in return, you own pieces of hundreds of America's biggest and best performing companies. At the end of the day, VOO is the foundation of my portfolio because it gives me exactly what I'm looking for: diversification, low cost, incredible long term performance, and something that I can confidently hold for the next 30 or 40 years without constantly worrying about if I should make changes. Now, let's move on to XLK because this is where I turn the dial up with my growth exposure. If VOO is the dependable Toyota Camry that's going to get you from point A to point B every single time, then XLK is the sports car sitting right next to it in the garage. It's got a little more horsepower. It's definitely going to be a bumpier ride at times. But if technology continues to do what it's done over the last couple of decades, it also has the potential to get you to your financial goals a whole lot faster. XLK invest in the biggest technology companies in the United States. I'm talking about companies like Apple, Microsoft, Nvidia, Broadcom, Oracle, and a bunch of other big tech names that are shaping the future of how we live and how we work. I know what some people may be thinking. Brent, haven't these companies already gone up a ton? Aren't I late to the party? Well, maybe. But people have been asking the same question about tech companies for well over a decade now and just keep waiting for this so called bubble to pop. Every year, it seems like people have this crystal ball saying that tech stocks have already had their run and the crash is imminent. And then somehow these companies still continue to find ways to grow their earnings and expand. I personally don't want to wait on the sidelines and miss out on all this growth opportunity, so I've just been dollar cost averaging my way into all these ETFs that I'm going to talk about in this video. And if this so called bubble does pop, I'm going to double and triple down on my bet that this ETF is going to continue to perform in the long run, and then I'm going to make a ton of money on the way back up. So either way you look at it, it's a win as long as you understand your investing timeline and know when you are going to need access to this money. And I have to laugh a little because I am a little tired about hearing about all this data center being pushed, and it kind of pisses me off a little bit. And like I said earlier, if you can't beat them, you might as well make money off them. And that's kind of my investing philosophy here. I don't have to personally love every trend that's happening in the world. I just have to recognize where the world is heading. If technology and AI are going to continue transforming the economy, and I think they will, I want my portfolio to benefit from that growth instead of sitting on the sidelines and complaining about it. The one thing I will say about XLK is that you have to be comfortable with a little bit more volatility. Tech stocks usually get hit harder during market downturns compared to something like the S&P 500. So if you're expecting a smooth ride every single year, this probably is not the ETF for you. But because I already own VOO serving as the stable foundation of my portfolio, I'm perfectly comfortable adding XLK on top of it to tilt my portfolio towards a sector that I believe will continue to drive innovation and earnings for years to come. And finally, let's talk about SCHD, because this ETF plays a completely different role in my portfolio than VOO or XLK. If VOO is the foundation and XLK is my growth engine, then SCHD is kind of like the adult in the room. It's the one that keeps things a little more boring, a little more conservative, but it's also the one that's designed to keep showing up year after year and quietly do its job. SCHD focuses on high quality companies with long track records of paying and growing their dividends. These aren't companies that are barely scraping by, these are companies that are super big. SCHD has a pretty strict screening process. It looks for companies with strong cash flow, healthy balance sheets, and very consistent earnings. So you got to be thinking these are businesses like Coca-Cola, Home Depot, ConocoPhillips. You can go look at everything SCHD holds. These are massive companies. And another reason I like SCHD so much is because it gives me a little bit more balance in my overall portfolio. When technology stocks are flying, XLK is usually going to wreck for me. But when markets get a little ugly and investors start running away from these higher growth companies for a little bit, dividend paying businesses tend to hold up a little better. They're usually established companies that people continue buying from regardless of what's happening in the economy. Now, does that mean SCHD is immune to market crashes? No, because it has seen some tough years recently. If the market does fall 30%, SCHD is going to fall too. But historically, it has tended to be a little less volatile than a lot of the growth focused investments, and I like having that built into my portfolio. I own SCHD because I love the psychology behind dividend investing. Every quarter, those dividends hit my account, and I don't spend a single penny of them. Every dividend gets automatically reinvested back into SCHD, which in turn buys me even more shares. Those new shares go on to earn dividends of their own, which buys even more shares, and before long, you've got the snowball effect that's working for you. I know there's always a debate online about dividend investing versus growth investing, and I think people make it way more complicated than it needs to be. I'm not trying to pick a side, I want both. I want companies that can grow my portfolio over the long run and consistently generate cash flow, while also having a little bit of downside protection that'll just add another layer of diversification to my portfolio. I would recommend holding SCHD in something like a Roth IRA where you won't get taxed on your dividends, but it's also not terrible to hold in a taxable brokerage account. Just know that you'll get taxed on those dividends as you receive them in a taxable brokerage account, even if you are doing the reinvestment strategy. At the end of the day, SCHD is not the ETF that's going to double overnight, and that's exactly why I like it. It's built for consistent dividend growth and letting compounding interest work its magic over the next 20 or 30 years. Sometimes the best investment isn't the one making the loudest headlines. So those are my three picks: VOO, XLK, and SCHD. If the fate of the universe was somehow on the line and I had to lock in those three ETFs, I'd feel pretty good rolling with this lineup. I don't think these are the only three good ETFs out there, and depending on your age and your risk tolerance and your investing goals, your portfolio could look completely different than mine, and that's okay. The important thing is understanding why you own each investment instead of just buying something because you heard it's popular on social media or because someone told you it was the next big thing. So I'd love to hear what your three ETFs would be. Let me know down in the comments. Maybe you've got a combination that you think is even better than mine, and if that's the case, I'd love to hear your reasoning because I'm always looking to learn. If you enjoyed this video and found it helpful, make sure to leave a like and subscribe to the channel. My goal is to help young professionals build wealth, make smarter financial decisions, and ultimately create more financial freedom. Thanks everyone for watching, and I'll see you all in the next one. Peace.